Good morning, everyone. Hi, hi, hi.
Happy birthday!
Thank you. What a great way to start my morning, my 63rd years with you all. Thank you, everybody. Oh, no. Meow. Thank you. But really, you think of ways you would want to spend your day. It's the only day of the year, really, where you might get your way. You really want to take advantage of it. Well, Open Circle, just exactly, absolutely right. I'm Kat Miller, and we'd like to welcome you to Open Circle. If you would, please turn off your cell phones. We'd appreciate that. Your neighbors would appreciate that. We'll remind you to turn them on at the end. Today's Open Circle mission statement is going to be read by Sophia Rose.
Good morning. Open Circle provides a supportive environment to gather for social interaction and to improve our understanding of ourselves, our community, and our world. Presentations span a wide range of intellectual, cultural, physical, and spiritual topics. We do not necessarily agree with the ideas and philosophies of our presenters. We encourage you to listen with an open mind and form your own opinions.
Thank you. We're always looking for presenters for Open Circle, and if you'd be interested, you can see Margaret Van Avery. She's right here. She has the fabulous hat on. And we're quite a ways out, so even if you're contemplating being a presenter, you might want to chat with her. You can also talk to David Bryan, who's in the striped shirt right here, and is our fearless leader. Yeah, it's pretty fun to talk. As you can see, we have a lot of good speakers, and I've done it a few times. And even if you're really nervous like I have been, it's worth doing it if you have something to say, of course. You can test that out with your family. Like, is anybody interested in what you talk about? If they're not, maybe not. We'd like to welcome those who are here for the first time. So if you're here for the first time, would you please just stand up? We'd like to acknowledge your being here. Ah, wonderful, wonderful. It's great to see you. Great to see you, have you here. If you're interested in signing up on our email list and have not done so, you can go to opencircleajijic.org, or you can go to where Brad is standing, who is filming us today. You can go on the tree. There's an actual pen and paper kind of sign-up list, so you're welcome to do that. While you're there, you can also cruise around the website and see photos from years past and now and what's going to be coming up. And you can also find your way to a page that's going to tell you to go to YouTube, Chapaladrone, which is where you can look at videos from past talks. Not everything is there, but they are meeting. He's been doing all the newest ones come up and all the earliest ones, and sometime they'll meet in the middle. Anyway, it's a wonderful offering that Brad and Open Circle are offering everybody. So that's pretty cool. So I'm going to tell you some possible jokes during this time. We'll start with 11 important facts. Number 1, death is the #1 killer in the world. Number 2, life is sexually transmitted. Number 3, good health is merely the slowest possible rate at which one can die. I'm going to skip one of them, go to number 5. I don't know. You're going to get on me about number 4.
That's all right. It's your birthday.
Number 4. Men have 2 emotions, hungry and horny. They can't tell them apart. If you see a gleam in his eye, make him a sandwich. Okay. See? Number 5, health nuts are going to feel stupid someday lying in the hospital dying of nothing. Number 6, all of us could take a lesson from the weather. It pays no attention to criticism. Number 7, in the 60s, people took acid to make the world weird. Now that the world is weird, people take Prozac to make it normal. Number 8, life is like a jar of jalapeno peppers. What you do today might burn your ass tomorrow. Number 9, don't worry about old age. It doesn't last that long. Number 10, oh God. Freud was right about penis envy, and he was wrong about who has it. Number 11, don't mess with old people. Life imprisonment is not that much of a deterrent anymore. How are we doing here? Let's see. We just got a little one maybe here. An elderly couple, Ray and Bessie, are seniors in Texas. Ray always wanted a pair of authentic cowboy boots. Seen some on sale one day, he buys them, wears them home, walking proudly. He walks into the house and says to his wife, "Notice anything different about me?" Bessie looks up from her knitting and gives him a once-over before saying, "Nope." Frustrated, Ray storms off into the bathroom, undresses, and walks back into the room completely naked except for the boots. Again, he asks a little louder this time, "Notice anything different about me now?" Bessie sighs, folds her knitting across her lap, and says, "Ray, what's different? It's hanging down today, it was hanging down yesterday, and it'll be hanging down again tomorrow." Furious, Ray yells, "Do you know why it is hanging down, Bessie? It's hanging down because it's looking at my new boots." To which Bessie replies with a cat-like grin, "Shoulda bought a hat, Ray. You shoulda bought a hat." I don't write them, I just sell them. Words of wisdom for today by Anonymous. Words of wisdom for today. There are times when my greatest accomplishment is keeping my mouth shut. Thank you. Next week's presentation, The Rise and Fall of a Foreign Retirement Community in Mexico, presented by David Truly. Mexico has a long history as a popular destination for often eccentric foreign retirees and expats. Recent changes in the socio-political climate and the influx of aging baby boomers, however, have resulted in a migration trend that has exerted significant pressures on both the natural and socio-cultural fabric of some retirement destinations. Private and public agencies now aggressively promote retirement migration to enhance Mexico's tourism development initiatives. Dr. Truly offers an overview of recent studies that reflect some of these changes in the Lake Chapala area and the role of the foreign and Mexican communities in this transformation. A brief overview of tourism and retirement research will shed light on the unique nature of this community and its fragile existence. David Truly has a PhD in geography and has studied retirement migration to Mexico since 1997. Formerly a professor at Central Connecticut State University, he has taught at the Universidad Autónoma de Guadalajara and has conducted the numerous studies on senior housing and healthcare throughout Mexico. He is currently living in Austin, Texas. And what I do want you to know is it's our largest generally, well, we have two, we have a couple. Yeah, you. It's a very large crowd usually for this, so if you want a seat up close, or want a seat maybe at all, come soon, come early. Is that right to say? Yeah. Okay. Before we move on to our centering moment, which I thought this would be a good moment to take a moment. As some of you may know, Amara Browers, she was on our steering committee, and she died last week. And actually this last Tuesday. And she died just after coming home from a month-long trip to Antarctica, actually with the woman who's going to do our centering moment this morning, Beth McDonald. And I'm so happy for her that she got to travel. It was her deepest wish these last years. Actually, most of her life she loved to travel and was quite physically active. And she came home and she was sitting in a chair on her porch. The sun was shining, looking out, and she died. She had heart problems and she knew it was coming soon. So we just want to thank her for all of her help and for just being the person in our lives that she was. Our centering moment, Beth McDonald.
Good morning. Our essential nature, who we are, lies in, around, and through us. Let's take a quiet moment to touch our center now. I'll call you back in 2 minutes. Just relax and breathe. Look to this day, for it is life, the very life of life. Yesterday is but a dream, and tomorrow only a vision. But today, well lived, makes every yesterday a dream of happiness, and every tomorrow a vision of hope. Look well, therefore, to this day. Thank you.
This week's presentation, Why All the Volatility and What This Means for Investors, presented by Yann Kostic and Tom Zachystal. The worst December for the Dow Jones since the Great Depression. Dow down 1,000 points one day up and 1,000 points down the next. Markets down 20% between October 1st and Christmas. We've all seen the headlines about the recent market volatility. After a decade of relative consistency and positive performance in investment markets, volatility has intensified. Last March, Yann and Tom warned of this possibility and even suggested it might start in October of 2018. In this, their fourth annual Open Circle presentation, investment managers Yann and Tom will give a historical perspective on investment markets and volatility and discuss the current situation and where we might be headed. Tom Zachystal, CFP and CFA, and Yann Kostic, MBA, are both U.S. registered investment advisors and cater to the U.S. expats in Mexico. You can read their regular column in the Lakeside Sun. I want to say that after last year when you made your prediction about 2018, I had a good friend that had quite a bit of money and was going to do something with it and had the timing issues. I told her what you said and she, you know, paid attention. So anyway, thank you for that. Please join me in welcoming these two, Tom and Yann.
Does that work better now? Yeah. Well, second time, good morning, buenos dias. How are you this morning? Beautiful day, it's not too hot, it's not too cold. Another day in paradise, right? Well, my name is Yann, I'm the big one. I'm an investment advisor, and yeah, obviously there's a difference. I'm an investment advisor and a money manager. And yes, thank you. This is the first time we're presenting here at Open Circle. And yes, CAD is a very difficult act to follow. We don't have as many jokes. Actually, we have none. So all the laughter is at the beginning of the presentation. We'd like to thank Open Circle, Margaret, and the entire board for having us this time a fourth time. So they're doing actually a great job with all their presentation, and yes, next week David truly is something that you can't miss. A couple years back in 2016, we talked about behavioral finance and the 4 different types of investors. Why am I mentioning this? We'll talk about it a little bit later on. So for whoever wasn't there 3 years ago, there are 4 profiles: independents, accumulators, preservers, and followers. And you generally belong to one of these groups. Well, most of us, at least. In 2017, we talked about populism. Without any politics, the last US presidential election was won on a wave of populism, which caught many of us by surprise. 20 years ago in Europe, there was only 2 countries that were populist, Switzerland and Austria. Today, we have over 9 countries, including Italy, Greece, Poland, Bulgaria, Hungary, Czech Republic, and a couple more. So the wave is important and is to be taken into consideration. Last year, we talked about crisis. What crisis? And we talked about all kinds of crises from 200 years ago up to 10 years ago, and mentioned that they tend to start in October. Stock market tends to have the biggest decline in October, but crisis also starts in October. So as a conclusion last year, we said, well, be careful, especially this year, or I'm sorry, last year in October, things may start to get a little funky. Of course, if we could predict perfectly the future, we would be on the yacht somewhere in the Caribbean. But what we do is we take all the information that we've gathered for so many years doing what we're doing and looking at what are the possibilities. And we analyze them and said, well, it could be possibility number 1, number 2, and number 3. Which one is the most likely to happen? That's what we did at the beginning of the year. So, and if you don't believe us, check on tape. We have no tapes available on YouTube. You can see that, yes, at the conclusion, we said, hey, be careful. So I'm glad some people took advantage of it. That's very good. We're glad. But this year, we're going to talk about something different. What are we going to talk about, Tom?
Well, first of all, let me say that the jokes keep getting better every year, because I remember in 2016 there were financial advisor jokes. So thanks for that. And what we're going to talk about is the recent volatility in the market. And I'm actually glad it happened because, quite frankly, the 4th year, we were initially warned, listen, keep it philosophical, don't talk about specific investments. And you know, after 4 years, we're kind of running out of philosophical things that we know something about. So now we get to talk about volatility and sort of bring together the last 3 years of stuff that we talked about. And you know, this prediction in October, it wasn't that hard to make because going back, you think about the crises that have happened. And so in 87, in October, we had the savings and loan crisis. In 97, in October, we had the emerging market crisis. In 2007, in October, that's when the market started going down for, the next 18 months. And in 2008, that was when Lehman Brothers happened, in October. And so now it's 10 years later. It wasn't such a hard prediction to make, really. I don't know why. Maybe that means we're over for another 10 years. That would be great. But anyway, so this year, we're going to bring together some points from the last 3 meetings, and we're going to talk about the recent volatility in the markets, whether it's something that's just transitional, whether it's something that might lead to something more serious. And then we'll talk about maybe some strategies for dealing with volatility. We're not going to go into details or anything, just kind of general strategies. I just want to point out that nothing we say, a little disclaimer here, nothing we say should be construed as investment advice. That can only be given, knowing your personal circumstances and so on. So these are our opinions, hopefully informed opinions, but that's all they are. And so what causes volatility, speaking about the investment markets? Fear is, emotion. That's right, investor emotion. Anything else? Greed. Well, that's the same thing, very emotional. But also, what about something like political developments, right? So recently there's been a lot of talk about the US-China trade, what should we call them, negotiations. Back a few years ago in 2016, in November, there was some volatility. Does anyone remember that event? The elections, right? Donald Trump, and initially the market went down, and then when people found him to be business-oriented, it went up as well, so there's some volatility there. So political developments. What else? Economic news. That as well, right? You hear about the Federal Reserve raising interest rates or something like that, or economic indicators. Then there's company-specific events that don't necessarily affect the whole market, but they might affect a company. Apple announces that revenue has slowed down and their stock price drops 30% in a few months. Things like that. Then there's other market volatility. So sometimes it doesn't start in the US. Sometimes it's not about the US. Right now we have issues in England, right? Brexit. We have issues in Europe, with Europe slowing down quite a bit. Germany is... They've had negative economic indicators for a while now. They're talking about recession in places like Italy and parts of Europe. So that's not helping either. And then there's also some more sort of technical things. There's a lot more computer trading these days. And by that, I mean not when you go online and trade for your account, but what we call computer algorithms. So they're automated trading algorithms. A lot of the hedge funds use them. And basically, they trigger. So the market goes down X number, they start selling. And the market goes up X number, they start buying, and they do this very quickly. And so that has made the market more volatile as well. That's kind of something that's getting more and more sort of popular over the last, I guess, 5-10 years, I would say. And then finally, sentiment, how people feel about things, right? So, and also we talked about biases a couple of years, 3 years ago, I think, behavioral finance type things. So there's a herding instinct among investors. And so it's almost like the computer-driven trading. The market goes down, you start panicking maybe, so people jump, market goes up, they jump on the bandwagon. So that as well contributes to the volatility. And it's important to distinguish between temporary downturns in the market and what could be more prolonged, maybe leading to a recession. It's not always easy to do, but what are we thinking these days, Yann? Is it a crisis or is it a temporary thing?
Well, as it was announced at the beginning, it was 20% between October 1st and Christmas Eve. For certain people, certain type of behavior in finance, it was, I've lost 20% of my account. For some other, it's a blue light special on Kmart, time to buy. Well, it seems like it was a blue light special because most big banks start to buy right after Christmas, and the market is back up over 10%, nearly 15%. So we've recouped most of what we lost during 3 months. But Goldman Sachs just Friday had a note out saying, well, it's all nice and good, but it was too far, too fast. Buyer beware. Maybe this January, which generally tells you if you have a good first week of January, you have a good January. If you have a good January, you have the good rest of the year. So maybe everything is hunky-dory and we don't have to worry about it. Well, not so fast. How we can compare to what happened these past 4 months to what happened 10 years ago? Well, the big bounce, if you will, that happened with 15% since December. That didn't happen last time. Last time, 10 years ago, it was waves of selling after waves of selling, and it happened 1 year before the collapse of Lehman. So what we can see is that, well, it looks good right now, but what will happen in the next couple of months is extraordinarily important. Why? Because maybe it was only just the first wave of selling. Maybe it will keep on going. And I think it was news-driven, and that's what is very important. The crisis lurks somewhere. You don't know where it's starting. Lehman Brothers, when they collapsed, it was years in the making. It just didn't happen, 2 weeks before. It happened years and years before with their dealings with the mortgage-backed securities and so on and so forth. So the difference is so far we didn't have that sharp recovery 10 years ago. But like we talked about, we're going to talk more and more about China, and we absolutely have to have a deal happening. Otherwise, the news again are going to be negative, and the market's going to most likely tend to be on the downside. So, what should we be paying attention to in the next, I would say, 2 to 6 months? Well, what is important right now, I think the elections are 21 months away, but I am sure that before you see those decorations at Costco and Walmart, those Christmas decorations in Walmart, the election, the US election, presidential election, is the only thing they'll talk about on all the networks. I think this next election is going to be, if the last one was bad in a sense of the way people treated each other, this one is going to be, I think it's going to be a doozy. I think it's going to be something that we'll remember for years to come. And not necessarily for the right reason, but it is our belief that the current administration, and again, apolitical completely, the current administration has to make all those achievements in order to be able to have an effective campaign next year. They have to deal with the Chinese. They have to deal with North Korea. It's a must. Now, I hear a lot of people telling us, oh, but the Chinese, they have to make a deal. They have to come to the table. Yes, they would like to come to the table because, it's a trade deal. The sooner it's done, the better it is for everybody. But they're no fools. Neither is, what's his name? I've got to read it because I don't remember. Xi Jinping, that's his name. And Vladimir, the other one is much easier to remember. But those guys, I don't know if you've noticed, they're in power for a very long time. They have a long time to go. They can wait. By the end of the year, if nothing is done, and I hope it's not going to be the case, but if nothing is done, they know that they will most likely have to deal with a different administration in 20 months from now. So they're not necessarily that much in a hurry. Yes, on the money side, they would like to get it done, but if it doesn't work the way they want, they can wait a little bit longer and things can look very different 21 months from now. I'm not making any predictions. So, yes, that's the foreign stuff. On the national stuff, well, the government has been reopened, but I believe the deadline is right after Valentine's Day, the 15th. Okay? Well, hopefully it's party great on Valentine's Day that we'll forget what happens on the 15th. But again, we hope everything's going to be all right. But with what we've seen so far, I wouldn't even give it 50% chances of them making a deal, and which shows that it was actually positive for both sides. So I think it is important to remember that nor China or Russia will come to cry uncle when things don't work. They will just wait and see what happens next. Meantime, we start to see chinks in the armor. That's his word. And if you look at the leading economic indicators for the United States, for the first time in many, many years, they're negative. No, not by a whole lot. No need to be so worried, but they start to be negative. And that's something to start to pay attention. And what they do, they predict what will happen basically in 6 months. What we've started to look at, the Case-Shiller Index that talks about prices, real estate prices in the main cities, metropolitan areas in the US. Now, if you were in San Fran, Vegas, New York, past 5-10 years, you made a lot of money on real estate. But those prices, especially the higher end, has topped out pretty much last summer. Not only from people telling us here, oh, you know what, the price is not as good as it's much harder to sell a house now in New York. Well, you're lucky if you have a house in New York, but real estate in New York, Vegas, price have topped out before. Last year, there would be bids and the price would go up, up, up. Now, they stay on the market. Whatever is expensive stays. Whatever is cheap sells, but whatever is too expensive. So the market has cooled off, if you will. Also in Europe, the leading indicators, especially in Germany, have cooled off as well, and now have been negative for quite a while. Well, it's just like for Europe. You know, Germany is like the United States. If the United States coughs, Canada gets a cold. Mexico gets the flu. In Europe, if Germany coughs, France cries and says, well, please help us. And the Brits are already talking about leaving. So those are the things that we have to take into consideration, that things don't look as rosy as they were about a couple of years ago. And finally, it was a very short time, but the yield curve, I'm not going to bother you with the yield curve, but basically the long-term interest rate and the short-term interest rate have kind of balanced out, and if it costs more the short-term than the long-term, it generally predicts a recession. And we like to say that indicator predicted 30 of the past 10 recessions. But it's something to take into consideration. So, now that I've talked about all this, I think, Tom, please help us with your perspective and your 20 years experience in the business.
Well, so let's talk a little bit how, if we're going to be more cautious, if we're of the opinion that we want to do something investment-wise, then how do we react to this volatility, right? And basically, there's three ways. And I remember having this conversation with clients at the beginning of 2008, sent out a letter because the downturn started sort of third quarter of 2007 and so on. And so there's three options. You can go to cash, you can write it out, or you can try to hedge the portfolio, meaning that you protect the downside. And really it depends on your own circumstances. I mean, and so let's just work through these three options. If you go to cash, then first of all, can you afford to do that? And how long can you afford to sit in cash? Although you can get, 2 to 3% in the States now in a CD, you can get more in Mexico, but then you may have to worry about the currency maybe, although if you're spending in pesos, that might not be a big deal to you. But you don't get much in cash, and inflation in Mexico is higher than it is in the States. It typically, emerging markets tends to be around 5%, States tends to be 2 to 3 or something like that. So can you afford to put your money in the mattress and sit on it? And then more importantly, if you do like to invest your money, when are you going to put it back into the market? Because what usually happens is starts going up, and they say, oh, the market's going up, I'll put my money back in, and that's usually the wrong time, right? So you got to think about what's going to be the trigger for putting that back in, and you can't just go in and out of cash all the time. You'll drive yourself nuts. So one strategy is maybe if you can do it, you can hold maybe 3 years worth of cash. I mean, the typical recession doesn't last longer than 2 years. Even the 2008 thing, the market went down for 18 months. So if you have 3 years worth of cash and then you just kind of leave the rest in the market, ignore it, and live off of that cash, then that's maybe one strategy. The other strategy is, well, you can ride it out. I mean, we've all seen ups and downs every 10 years for one thing, and plenty more smaller ones over the course of years. I mean, every other year we get a 10% downturn typically, right? So you can write it out. And then you got to think about, well, are you really going to do that? Or when your investments are down 10, 15, maybe 20%, if you're more aggressive, are you going to pull the plug then? Because that'll be the wrong time, right? Maybe you can live off of the dividends and forget about the capital gains. Maybe you have other income, Social Security, annuities, pension, guaranteed income, and you can ignore the fluctuations in the portfolio, right? So that's another option. And it depends on your time span as well. A worst case scenario, it might take 5 years to recover, maybe longer, from a really bad downturn, right? Then the third option is hedging. It's a little more complicated. We're going to actually talk about that Tuesday a little bit, but essentially there's different ways to hedge, but what you're doing when you're hedging is you're betting on the downside. And so the bet you place on the downside of the market offsets, if the whole market goes down, it offsets the losses in the rest of the portfolio. That's what hedging is. There's various ways to do that. But it's hard to do successfully, and when we start talking about things like buying put options and so on, it gets a little complicated. It's usually not for the average investor. And it's hard to do in an IRA account sometimes too, because for various technical reasons. So what do people really do? And I have an interesting perspective, I think we both do on this, because I've been doing this for about 20 years, and let's say I have 120 clients that I deal with personally, and so I get all kinds of perspectives on this. And in 2008, I had clients calling me, oh, let's get out, this is terrible. I had one guy, because I used to be in the oil business, I worked for Schlumberger, I have some clients in the oil business, and one guy was texting me for an offshore oil rig, sell everything, sell everything. I said, you want me to sell everything? I mean, I'll sell everything, but why? Why sell everything? And he says, no, you don't understand. I've got 5 properties. They all have a mortgage. They're rental properties in New Zealand. I have a mortgage on all of them, and I need that cash to fund my properties because I'm underwater on them, right? So things like that happen as well. So I've got an interesting perspective from a lot of clients, and what I've seen is 2 things. So first of all, we all do a risk tolerance questionnaire when we bring on a new client, right? You fill out the questionnaire. It asks you such exotic questions like, sometimes it feels like they're totally unrelated. But in any case, hard to answer questions like, what if your investments went down 20%? Would you be okay with that? What if they went down 10? What if they went down 30? So they're hard to answer sometimes. And what I find is people answer those questions, but then when the time comes, they don't really correspond to the answers the way they feel, right? So that's one thing. You feel differently when you're in the middle of it than you do when you're filling out the questionnaire and times are good. The other thing I've seen is what we called, the biases we were talking about, behavioral finance, what we call loss aversion bias, which is that you sell winners too early. People tend to sell winners too early. The price goes up and up, and they say, well, it can't go up forever, I'm going to sell, and then, it still keeps going up. And they tend to hang on to losers too long, and this comes into play especially if you make an investment and then the whole market goes down and you're hanging on to that. Maybe the circumstances for that company or that investment have changed, but you've just put your money into it, so you say, wow, I'm going to leave it in there because it's going to go back up. If the circumstances have changed, then your opinion should change as well. So that's kind of what I've seen. But it also depends on the kind of person you are, right, Yann?
Yes, and let me go back full circle, and pun intended. When we talked about 4 years ago about different groups of people, we were first talking about independence. Well, I'm sure there's not many independents amongst you today, because those are people that work by themselves, do things by themselves, think for themselves, and don't need our help. We are independents, but most investors that works with us are not independent because they are the type that do things on their own. Then come the accumulator. Those are the ones that in the past have accumulated wealth through work, through companies, through real estate, and they feel very confident that in their abilities to make money. And they think the stock market is the same. Well, if their previous job or previous companies they own prepared them for that, they will do well. And they tend to do actually very well if they really understand the financial markets. But if they don't, well, the opposite happens. They're the ones that are too confident and take too much risk, and when things go bad or go south, they really get hurt. The preservers are the ones that are worried. They're worried short term, they're worried about losses. They have the finances, but they're worried about growing their wealth. And, well, to grow your wealth, just like when you start a business, you have to take some risk. And they generally are risk avert, and they're the ones that actually could use the help of an advisor to help them balance out their own fears. Always, whatever advisor you might use, always make sure that they're fiduciaries. That's the key word. I will repeat it forever and ever. The F word, fiduciaries. Make sure that your advisor is a fiduciary and place your interest before their own. About 10% of financial advisors in the United States are fiduciaries. All the other ones, I won't name them, but stockbrokers and so on and so forth, are not fiduciaries. Make sure that they are. And finally, we're talking about followers, and might have quite a lot of followers today. And they're people that they're not sure. They make their decision based on what the friends may advise them to do. They are followers. They follow trends. They'll say, "Oh, Apple is up. Let me buy Apple." And those people tend to lose the most because they don't really have a complete plan, a long-term financial plan. So they want to participate in the stock market. They're interested. Market has been up for 10 years. People have made fortunes. Triple your money in 10 years. Very few real estate investment do that. But by the same token, they want to follow, and maybe they said, "Hey, buy the dip. It's down 20%, and they're buying now. And they're 5%, and they're happy." Well, maybe by the end of the year, it'll be a totally different story. So again, those people may need the advice or the counsel of an advisor. Again, the F word, fiduciary. Always make sure that whoever advises you has your interest first, not theirs. And generally, those are not based on transaction cost. They charge you a fee per year to help you manage your investments. Now, and that, of course, leads us to financial planning, which is Tom's specialty.
Okay, yeah. So I'm going to tell this joke now. I'm going to tell a financial advisor joke. This is the same one I told 4 years ago, so if you're here, sorry about that. But, you know, I got to tell one joke, and it's, what's the difference between a broker and a registered investment advisor? And so, or how many investment advisors does it take to manage a portfolio? And the joke goes something like, brokers love to tell this joke. It says, well, it takes two, right? One to invest the portfolio, and the other one to charge you 1% for the rest of eternity, basically. Anyway, so that's my little joke, okay. But the sad reality is that we may not be able to tell when we're in a prolonged downturn until we're actually in it, right? And then when you're in it, it's pretty hard to tell how bad it's going to be, right? In 2008, for example, I remember the market would go down, and then the Federal Reserve would jump in and say it was some kind of a stimulus package, the market would go up again, and you know, the same thing would happen over and over again, and then Bear Stearns failed in, I think it was March or April of 2008, the market went down, and then it went back up again, amazing. And then Lehman Brothers fell in October, and the market plummeted. But, so there were a lot of events that happened, but it was really hard when you were in the middle of it to know whether it was just going to be yet another recession that we've all lived through before, or whether it was going to be something more sinister, right? But there are some signs. So for one thing, you tend to get one event after another, rather than what we've had now, which is news events, but you can kind of see the other side of the news event. If we're talking about a trade issue between China and the US, well, that's a news event, but you can see the other side of it, because at some point, neither China nor US is going to want to be in a trade dispute, right? And so you can see the other side of that thing. But talking about, so how to deal with this, talking more about financial planning things, one of probably the number one issue financial planning-wise for people in this room is how to maintain your lifestyle in retirement, right? That's, I mean, you're not too worried about college education probably and stuff like that. And so it used to be, for example, that we had this thing called the 4% rule. You could take out 4% of your portfolio a year and you'd never outlive it, and that was based on research that had looked at 30-year time spans going back as far as they could go back, and even if you'd gotten in at the very worst time, you could still take out 4% and not outlive it, right? And recent research, actually, there's been a lot of research because of demographics in this area in the financial planning community in the last few years. And there's been research on what we call, you know, optimizing sustainable withdrawal rates is the way we call it, right? And there's a way to get that 4% up to 5%, 5.5%. And it has to do with something that on the surface of it sounds pretty simple. And it essentially works out to taking more money when your investments have gone up and taking less money when they've gone down. And there's various strategies for doing that. You need some guidelines. Maybe you don't take an inflation adjustment some year or something like that. We're going to talk more about that on Tuesday as well. But that's kind of the range you can think of withdrawing without outliving your savings, 4 or 5% maybe if you've got a more dynamic strategy, that kind of a thing. And then just to kind of wrap things up a little bit, so what's on the horizon, right? We talked about there's a recession in Europe, there's the slowdown in China, there's also a potential debt crisis in China, plus there's the trade issues. There's this election coming up in 2020. If you listen to the State of the Union address, the campaigning has already started, it seems. And so there's bad news, but there's good news too, because one thing is that when you have sort of a V-shaped recovery, in other words, the market went down hard to Christmas, and then it went up hard in, to the end of January, let's say, you don't see that very often in the middle of a crisis. You typically see something like that if it's a temporary downturn, if it's at the end of the crisis. So that's the good news, right? And so there's bad news and good news, but in general, I would say it's a time where if you've got the means to do it, maybe it's time to be a little more cautious. I mean, we're not panicking or anything like that, but maybe it is time to be a little more cautious. Things are still good in the States, at least. Low unemployment, but as Yann mentioned, leading indicators negative. 1 month negative doesn't matter because one of the leading indicators is the stock market. So when it goes down hard, that drags everything else down. But nevertheless, there are some things to be concerned about, and so maybe it's time to take it a little bit easier.
Yes. Well, overall, we didn't want to scare you last year. We said things could happen. We're lucky on that prediction, I guess. But it's part luck and part, if you're doing something and work hard at it, the luck comes along with it. Our prediction for this year, well, we have key elements that are happening next week. We hope they'll go on the right side. And if Congress finally works together, things will go better because the foreigners looking at the U.S. right now are waiting to see how things are happening. So that's the first thing. The second thing is, if there is a crisis, it's lurking somewhere, and we don't know where it's going to happen. It may have started already, and maybe on our next presentation next year said, hey, we told you so. Look at that video, 35th minute. We warned you that, you know what, something may happen. And, well, it may not happen. Typical financial advisor stuff said, you have to be careful, but, overall things look good, but. So, if you're not sure, and if you're very confident, that's fine. If you're not sure, seek advice. It's like anything else. You need somebody that does that on a daily basis, and you can live your life and be happy. On that note, on Tuesday, and it was not advertised for LCS, I don't know, there was a problem with the newsletter. They did not advertise. We will have a follow-up on what we did today on the Sala, Tuesday the 8th at 10 o'clock. And it's generally a much smaller group at that time, so we can answer maybe more personalized question.
Tuesday the 12th.
Yeah. And we will be able to, further talk about a little more details. And right after this presentation here, we invite you to come have a beverage with us, coffee, soda, or I think they've got margaritas as well at La Vie en Rose, which is 2 blocks away this way on the western side. And we'll be there for an hour talking with you, maybe answering more private questions. And we'll be able to, answer all of your questions. Hopefully, not all of you are going to come, but, that way we can answer, some questions. But we invited to come, and we'll take the time to talk to every single one of you. I think that pretty much wraps up this 2 blocks away on La Vie en Rose. So right across from Barber's Bazaar. Everybody knows where Barber's Bazaar is, just right a little bit before on your left-hand side. That pretty much wraps up for the presentation today. Thank you for coming. Thank you for listening to us. Hopefully you learned something. And now we're going to go to the questions.
Questions. If you'd like to ask a question, if you'd raise your hand, we'll bring a mic to you. If you would stand up, hold the mic really close to your mouth and ask a question. We want questions more than opinions. Oh, okay.
So I heard you talk about stocks and cash. Could you talk about precious metals and cryptocurrency? And what do you think about global debt and the U.S. debt?
Hey, man, you're hogging like the whole question-answer period.
That's an excellent topic for next year. We'll talk about
Can you talk about one of them?
Yeah.
Choose one.
Well, cryptocurrencies is easy because, I would just say that to me it's always seemed like, one of the cryptocurrencies is Ether, and it's always seemed a little ethereal to me. It's pretty volatile. We don't invest in it on behalf of our clients. The movements seem random to me. I think it's pretty hard to do research on it. There's no dividends. And so, frankly, I stay away from it. But if you want to speculate a little bit, then go for it.
Yeah, right here.
How do you find out for sure if your financial advisor is a fiduciary? Obviously, you can ask them, but is there some certificate or something they show you that so that you know for sure?
Well, I guess you can never know for sure, but no, generally they're supposed to tell you up front. There's 3 letters that are associated with a registered investment advisor. In order to get that title, you have to pass an exam, and you have to put your client's interest first because you have to follow the ethics code. Now, there is fraud everywhere, and I'm not saying 100% of them are perfect, but at least you've got that guarantee, and those are the people you want to look for. I'm sure Tom has something to add to that.
Yeah, I mean, that's how you tell the difference. It's a difference in licensing, basically. So registered investment advisors, which is what we are, have a Series 65 license, and there's a fiduciary standard for RIAs. For brokers, there's no fiduciary standard, although some brokers also conform to that standard. So the best way is just to ask. They have to tell you. Right?
But the ratio is 10 to 1, really. Fiduciaries to non-fiduciaries, the ratio in the US is about 10 to 1. 10 are not, and 1 are.
Right here.
Hi. For those of us who are full-time non-U.S. residents, but American citizens, I understand that there are really only a handful of brokerage houses who are licensed to deal with us, to work with us. Do you know which ones those are?
We work with them.
Yeah, we work with them. So we don't hold our clients' money. Most registered investment advisors don't. We use a custodial firm to do that, which is a discount brokerage firm typically. The firms we use are TD Ameritrade, Interactive Brokers, and Pershing. I know TD and Interactive Brokers, by the way, is great. You should look them up because they will deal with U.S. expats living anywhere. Most of our accounts are with them. We have people who are with TD and live here, so I think TD Ameritrade, although their policy keeps changing. Pershing will deal with people anywhere as well, but they only deal through financial advisors, so you're not going to be able to use Pershing unless you go through an advisor. So those are the 3 I know of. I'm sure there's others, but those are the 3 I know of. Yeah.
And I may add, in the future, it's going to be less and less firms that want to deal with foreign-based account, or if you're an American citizen living overseas, the IRS is making it extraordinarily hard. So most banks, most people just don't want to touch them. Again, one of the best. Yes, I concur. IB is one of the best, but it's more like a brokerage firm or a custodian for professionals. It's arranged this way, so it's easier if you work through a professional than if you go by yourself.
Yeah, let me just add, because with Interactive Brokers, what they don't allow you, if you have a foreign address, is they don't allow you to buy U.S. mutual funds, which they actually shouldn't, because mutual funds have to be registered where offered, as it said. And if you're living in Mexico, they're being offered in Mexico, they're not registered in Mexico. So Interactive Brokers will not allow you to do that. TD, for whatever reason, ignores that. So they will allow you to buy mutual funds. But the other nice thing about Interactive Brokers is for a taxable account, it's multi-currency. If you want to exchange pesos to dollars, you get a really good rate, and you can wire in and out in pesos if you want. So it's a pretty good deal that way, too. So a little plug for them.
I'll make a point to that because it's very important. Most banks will tell you you can't wire pesos here. That's a bunch of, you can. They will not give you the number. I said, no, you can wire pesos at a much cheaper rate. The spread between what you have here and buy at any local bank, you can drive a truck through it, really. Over there, if you have this type of account, you'll buy with it 1 cent of the commercial rate, which is right in between. So here, if they sell at 18 and buy at 19, you'll buy at 18.50, which is depending on the amount you want to transfer. Like if you want to buy a house, you're talking 5 or 6% difference. That's a lot of money.
In the back, and then up here in the front, please.
I'm Canadian, and as I'm sure you know, marijuana is now legal in Canada, and the stocks have been up and down and up and down. I'm just curious if you have any comment on that product or those stocks.
Why are you looking at me like I should know about marijuana?
Well, here's what I know. If it is illegal, I thought there was a recent vote that makes it that legalized marijuana at the federal level in Canada. I think it is now legal, and that's why a lot of companies. My son lives in Colorado, works for Google, so has nothing to do with marijuana. But A lot of companies, a lot of companies, is a Google head. A lot of companies actually, if they're not allowed, one of their plans is to move up north to Canada. As far as stocks are concerned, we cannot talk about specific stocks, but there's been a trend, a strong trend for all the alcohol, large alcohol companies, bottlers, producers of alcohol, buying them left and right. So stocks are moving quite a lot. It's very risky because I think some valuations are just out there, expecting not for them to sell marijuana to every single citizen in the United States, but rather to be bought out by, a large, what I call alcohol company that sell wine, vice companies.
Yeah, I mean, sorry, did you notice how quickly all the Canadians nodded their heads when I said, yep, it's been legalized at the federal? I grew up in Edmonton, by the way, but.
Yeah, one right here. She's been raising her hand for, okay, you and then right here, please. Okay.
Close to my mouth, right? If you're a preserver type, any strategies for when you take required minimum distributions?
Well, so you have to take them during the year at some point. And we generally take them in December because it's just a question of keeping the money invested as long as possible because it's tax deferred. But so here's an interesting thing you might want to think about. The stock market, at least, goes up from November to May a lot more than it goes up from May to November, statistically. So if you are looking at rebalancing or taking money out, think about April. Think about March, maybe, because that's just a statistical, I don't know why. They say maybe everyone's on vacation in the summertime and nobody's doing anything, I don't know. But that's statistically the way it goes. So rebalancing, taking money out, one time to look at it is maybe in April, right? And sorry, I don't know if we answered the marijuana question fully, but what I found is I actually had a look at that because you're not the only client that's been asking about that lately. And what I found is that most of the marijuana companies that are not terribly volatile, I know there's some Canadian ones that I'm really not that familiar with. There's some that are specific to marijuana, but a lot of them are owned by a larger firm and it's part of their business. So it's not just a marijuana investment, it's also something else. So I don't know a lot about it, but that was my comment there.
I was going to ask you something about the marijuana also, but what they're looking at, though, because I'm doing a lot of investigating right now.
Hold it close, sweetie.
And I'm seeing things with products that they're going to be making in line with marijuana, and companies are looking at that. But also, I keep hearing about artificial intelligence and how there's now the G5 and how they're going to be going forward with it. What are your thoughts on that? That some of the companies that exist already, like Cisco and some of the others, but what about newer ones that are coming up? What kind of things should we be looking for?
Well, I'll take the first part of the question. I'm not exactly sure what's the relationship between marijuana and higher intelligence or artificial intelligence. Maybe you've got the link, and maybe it all makes sense all of a sudden. From what I've heard and seen locally, maybe there's a market after all, but we'll keep it quiet. Legally, the market is growing. It's undeniable that more states will legalize marijuana in the coming months or in the coming year. I think eventually the U.S. will do like Canada, whether it takes a couple of years, a new president, I have no idea, but I think the trend is there. It's not going to change. It is also the trend in Europe. And so marijuana is here to stay. Now, what they will do with it, I'm sure there will be more research, and maybe they can do drugs based on the components that you can find in marijuana, that you no longer use it, to get a high, but, to cure this or that, or to actually relieve pain, which I think is the main idea behind it, or officially the main idea behind it. As far as the artificial intelligence, you have a lot of companies, from startup companies, but a lot of companies are involved with it, including all the high-tech companies that you have in the U.S. And I don't want to say specific ones. It's not investment advice, but all the large U.S. companies are involved with it because it's the future. I won't mention it, but I will let Tom talk about it.
It's hard to answer this question without really giving investment advice, but some of the trends, if we're talking about trends, that I'm interested in, let's say, from an investment perspective, are things that probably spring to mind. So clean energy, for example, right? Solar power is probably not going away, and a lot of the solar power companies have been beaten up. Some have gone bankrupt. So there's probably some gems in that crowd. Then things like 3D printing. There's another one where the companies have been beaten up, but 3D printing is not going away either. Autonomous vehicles. I wouldn't necessarily, all the car manufacturers are now looking at autonomous vehicles, self-driving cars, but that might be the kind of thing where it might be better to look at the suppliers for those vehicles rather than the, Ford or GM or something like that. So those are the kind of trends. But one thing I will say is that what I've noticed, and this happens almost every time, is you get a hot company that's in a market. Like take 3D printing. There's this company called DDD, right? 3D. And you look at when it started out, and everybody was talking about 3D printing, the stock price goes up, 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 and it was just a little company, right? And then you kind of look at it, and they're actually not making money, and it plummets, right? And you see this trend almost all the time when it's some kind of a new emergent technology. The companies that are in it, everybody gets all excited about them. They go up astronomically. Then after that, they collapse, and then the survivors, the ones that are actually making money, there you have more of a sustainable growth rate. So think about that pattern if you're going to invest in some of these companies.
We have one last question in the gazebo.
Just a clarification question. You had mentioned that you're both Series 65, but wouldn't Series 63 and Series 66 also be considered investment advisors?
Yes,
Just so people don't go back and say, oh, but you're not a 65. You're a 66.
Yeah, sorry, that's a good point. So it isn't necessarily the licensing, and you're right, a Series 7 and 66, I believe it is basically the same thing. And some people have neither, because you could also have certain qualifications and not have the license. Like, for example, I have a CFA, so if I didn't already have the Series 65, a CFA would give me an exemption for that, or a CFP would as well, Certified Financial Planner. So it isn't quite correct that it isn't the licensing that makes you a fiduciary, but registered investment advisors generally have either an exemption based on their qualifications, or a Series 65 or a 7 and a 66. Yeah.
What I would say actually is the 65 is the most common that you would get. Yeah. The ones that you were mentioning are also, but again, the ratio is maybe something like 10 to 1. So this is the most common one. If somebody has a 65, you can say, oh, most likely, but then again, it's better to ask it. And if somebody doesn't want to answer you on the phone, I was just thinking about it, just put it in writing.
Yeah,
that way you have once it's put in writing, it's a total different story. Just before we part ways, again, on Tuesday at the Sala, starting at 10 a.m., we will have about an hour and a half presentation that is with a smaller group. It's reserved only for LCS member. Forgot to mention that. So maybe it's time to renew your membership. And right now we will we will answer further questions, and you can talk to us. We'll be at La Vie en Rose again, 2 blocks away from here, for about an hour and a half. Yeah. Thank you for coming today. We really appreciate it. Thank you.
Okay, everybody, most of you know the drill. You newcomers may not. Please stack your chairs, pick up your coffee cups, turn on your cell phones if you choose. Take your conversations outside as soon as possible. And we appreciate your being here. Thank you so much.